They rate your credit. Many of them. Not all, but many of them do. The A-rated companies do look at your credit before they insure your auto, home, or you.
Welcome everybody back to another exciting show of the About That Water podcast, where we help you build strong financial habits. My name is Anthony, and I have the ultimate opportunity to bring on LaShundra Harmon, who is the owner of the Financial Mommies and also the awesome author of Girl, Boss Up and Lead. How you doing today, LaShundra?
Hey, Anthony, how are you? How are you? Glad to see you again.
Yes, it's been so long. I think it's at least 8 months now since we last.
FinCon.
Yeah. We got
great though.
Yeah. Yeah, so much fun. So one of the things that I wanted to have you on, because you were telling me a little bit about yourself in the financial realm, and you are heavily focused on the insurance side of the house. So yes. Can you just give the people a little bit of background of what got you into insurance?
Well, there were a few factors. It was pretty much dealing with the deaths of loved ones. And my cousin passed away at an early age of 36, 6 weeks after having her daughter. And she had life insurance, but she had gotten remarried. And unfortunately, she hadn't gotten a chance to change documents and getting her affairs totally changed over. And me watching that process, as well as the next year having to become the financial and medical power of attorney for my grandmother, who had developed progressed dementia, and watching everything play out, whereas we didn't have enough long-term care for her. So just those two things really made me know that I need to talk to people. I need to educate our community and let them know that there are so many things we're missing the boat when it comes to having our affairs in order. Having adequate life insurance, having, things where we don't become a financial burden on our kids when we get older and stuff like that. So I went and got, I'm a second generation insurance person. My mother was in insurance before I was born. And, I'm 51. So that was over 50 years ago. So
you don't
just, yeah, I'm 51. So I decided to go into insurance coming from the mortgage and real estate industry. I'm a former salon owner. So, I'm always own my own business. So I own 2 salons on the south side of Chicago, and then went into financial services. So I come from the mortgage lending and real estate industry, and now into insurance and annuities and investing. So I'm a registered financial consultant, but just to educate in our community. So I do own a boutique insurance firm where we do all insurances, business insurance, all of those different things. But my main focus, of course, is life insurance and investments. And with the Financial Mommies, which is my organization that I started I teach financial empowerment and entrepreneurship in the schools in the Chicago area and to special groups. So I just decided to say, you know what, I need to educate, I need to empower, and I need to show us how to have that relationship with our money and learning how to use life insurance to do it.
Yeah, because we always hear this term life insurance, but you also talked about being a power of attorney. Can you break down a little bit who are involved in this life insurance policy?
Well, I just actually, it's funny you bring that up. I was talking to a client actually earlier, and she was referred to me, and unfortunately her sister had passed, and her mom had, purchased the policy and stuff like that. So at the time, her mom was the owner and the payer and the beneficiary of the policy. But unfortunately, my client right now who pays the policy, I'm looking, her mom was the beneficiary and no one ever changed it. So it's going to open up a can of worms actually for her when she gets ready to, because the sister passed. So there was no beneficiary listed, unfortunately. And so you have to be aware of how the owner owns the policy, which means they dictate everything that goes on with the policy. And they all can be different. You can have the owner, the insured, you can have the payer, and the beneficiary. A lot of times they can all be 4 different people. Most insurance companies, though, want you, if you're over the age of 26, for you to be the owner of your own policy. But say, for instance, if your mom gets a policy on you or a grandparent or something like that, you have to have an insurable, an insurable interest in the person. So I just can't go get a policy on somebody. I got to say it's somebody that I'm either a guardian or their parent. So the owner is the person who pretty much dictates everything about the policy. And then there's the insured, who the policy or contract is on. And then the beneficiary is the person, when the person passes away, who gets the tax-free money to, of course, bury the person, and whatever financial proceeds are left over goes to the beneficiary. And then the payer could be whoever. So, you don't have, the payer thinks that they can control things, but just because you're paying it doesn't mean you own it.
It's almost like when you buy a house, you have the title and the deed and the mortgage. So somebody can be paying the mortgage, but not actually on the title or the deed. So
that means probate, going to the court, showing interest. So like if that person was paying the mortgage, they still can have rights because they were paying into the mortgage. They have interest in the mortgage, financial interest in that property because they've been paying into it. You do have a say-so on the mortgage side. So yeah.
Do you have that same rights also when it comes to life insurance policy?
No, unfortunately, you don't. Whoever the owner is the owner.
Okay.
So if the owner passes away, beneficiary passes away, and the insured dies, probate.
And probate meaning like, so if I hear about it,
court.
Goes to court. So that means like if I was in court and I heard that all these people have passed away and it's up on the probate, I can go in there like, hey, yeah, I know these people. Just wind up getting it. Is that possible?
No.
Okay.
No, what ends up happening pretty much is the judge will rule, over whoever the estate, because it goes to your estate. And unfortunately, as I said earlier, we often don't have our affairs in order. So there is no will. There is no trust in place. So it's like a free for all, and probate can take a very, very long time sometimes, if the parties don't come to an agreement once in front of the judge.
So what should we do in our community? What are the number one thing that we should do? Or at least start?
Well, one thing, like I tell anyone, if you are a parent, if you own a business, or pretty much if you're young and healthy, get you a life insurance policy. Start it early because one, the premiums are cheaper. Have that. That's that whole financial need analysis can be done, and it's in place. You're locking in your insurability when you're young and healthy. That way, if you get a policy, a lot of times the insurance company will give you more the older you get because circumstances change. You get married, you buy a property, you have kids. So that locks in your insurability, saying, okay, this person is healthy. We've already insured them for $100,000. We can insure them up to $1 million or whatever the number is, and they may not have to do an exam. So get that locked in. And once you do that, talk with an attorney, get you a trust put into place, stating what you want done with that money when or if you pass away. Because sometimes, like I say, we talk about dying a lot of times with life insurance. What if you don't die? What you doing with the policy while you're here?
And that's with the term policy, if we outlive the terms of the life policy, right?
Well, you know what? When it comes to term, term definitely has its purpose because to me, you get more bang for your buck with term. So versus going out the gate and getting a cash value whole life policy. So if you're young, I would suggest a term because it's inexpensive and it covers you at a level premium for a certain amount of time. So you can get a 5 year, 10 year, 15, 20, 25, 30, 35 year term, which means that premium stays level. If it's $50, it's going to be level for however long the term. But after that term is done is when you can lose your mind, because that means that the cost of insurance it's annual renewable every year. That means the premium is going up, 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 because the cost of insurance is based on your age. So you get it at 20, 30 years. Hey, how old are you in 30 years? You're 50. So the cost of insurance is not what it was when you were 20. So it's way higher, and then you have to reevaluate that. So it's always good to get a term that's convertible to a permanent, not just straight term. Because what if you develop an illness which may deem you uninsured?
Right. But if you become that illness while you have the term, will they jack up your
If you
premium?
have a convertible.
Oh, only a convertible. Oh. Okay.
Or
So
you'll be stuck paying premiums that you can't really afford to pay. Be a lot each year because it's going to change because your age is going and the cost of insurance per 1,000 is different. So say for instance, you have 100,000 at 20, you get 50 with a 30-year term. That cost of insurance is going to be way high from 20 for $100,000. It's going to be a lot.
Right.
So you rather get a policy that can convert so you don't lose out on the money that you've been paying. Because with a term, if you don't die, just shoveling money into the fire.
Okay, so to protect ourselves, first we sign up to get the insurance. Make sure it's convertible insurance.
Yep, make sure it's a convertible term insurance. Yep, if you're getting a term.
Okay, and then we make sure we get a lawyer to then draft us up a will.
A will or a trust. You want to get a trust, especially if you're owning property, business, and all of that. Yep, you want to get a trust so that way you have a trustee. And Lord forbid something happen, your things are together. It won't go to probate. No, and a will is contestable. Remember that. People think, oh, I'll just get a will. What if somebody come from out of nowhere? They can contest it. Whereas a trust can't contest the trust.
Interesting. Okay, now you got me going. All right, so we make sure we got the trust. So after the trust, what parties? Because you said there's parties inside the
insurance policy.
Inside the insurance policy. Now with the trust, are there a certain set of people that we need to have in a trust now, like a team?
Well, a lot of times when you sit down with your attorney, like who you can appoint a court-appointed trustee, or you can have someone that you love near and dear to be your executor or trustee. So I want my sister or, my brother. I'll make sure that, because they can't go past whatever's in my trust. They have to. They're just the ones overseeing that everything is properly done in my passing. They can't change it. They just got to make sure it's completely done.
Now, isn't it like one where it could be like have a financial person to kind of help divvy it out? It's like a financial person and part of the trust.
Well, you know what? It's not so much as the financial person is a part of the trust. You're sitting with your financial person.
Okay.
While you're completing the trust. So your financial advisor would be me, or, if you want to sit down with your CPA, most often you want to sit down with your financial advisor who is making sure you have adequate insurance, where your annuities are, your whole financial package together going into the trust. You'll sit with them before, and then the attorney next.
Okay. And then so we got all that set up. What's the next step after that? We should be good, right? After those two big ones, which is the
You
life
can be.
insurance
You
and
can be.
trust.
That's
Okay.
just like us now, Anthony. Like you. You have your business.
Mhm.
Even if you didn't have life insurance yet, you can still set up your trust. You can add things as you go.
Oh, okay. And this is a revocable trust, right?
Mm-hmm. Yeah,
Okay.
so you can add your trust. Once you set your trust up, you can add whatever into it as you go. Because the older you get, like I say, your circumstances change. You may need more insurance. You may buy some more properties, which means you're going to need more insurance for your heirs. So that way, when estate taxes come, it can be paid out of the life insurance policy versus the taxes on what's in the trust.
Right. And then also, I guess, passing down, because you mentioned earlier, tax-free money. So
Yep, to the beneficiaries.
to the beneficiary. So they don't, oh, wow, that's really cool. Okay. And then also because if they have assets like a house or something like that, if it's already part of the trust, it will never actually transfer to their hands. So they don't even have to pay uh, they don't have to do what they call it, the estate tax,
Yeah,
because it's coming out of the trust anyway, which was
yeah,
already set up.
yeah.
Oh man, I like this secret. This is a gem. This is a gem.
Yeah, it's called, you can do a ILIT, what it's called, a life insurance trust.
Hmm.
So it's a lot of different, man, let me tell you, I sat through a training one day and I swear there are so many different types of trusts that protects your money. And we as a community are missing the boat because we aren't educated and people aren't talking about it. We're so quick to, everybody's so hooked on what TikTokers and people on Instagram are saying, but it's a lot more to it than what they're saying. It's a lot more. That's why I say sit down with you, a licensed financial person, a registered person who really knows what to do for you. You can do a certified financial planner. You can do a registered rep. All of those people know what these different trusts are for you financially to protect your life insurance portfolio and stuff like that.
So now that we have them, do we just print it out and then put it in the safe and hopefully it doesn't get attacked by natural elements? Like, what do we do?
You can hold it electronically or have it, you file it because it's something that you have to get notarized and filed. So you file that trust and it's protected by the court.
That is so simple. Like, it sounds so simple. And I'm sure it's like no more than what to get started. What, like $300 maybe?
Wait, I'm sorry. What you say, Anthony?
To get it started, it shouldn't cost no more than about $300, correct?
It depends. Like me, I did mine myself. The most would be like pretty much when it comes to like court stuff, you paying those different fees like that. But I started my trust myself. Went online, got the document. By me being a licensed financial person, I kind of know what to do, what I'm putting in there, my policies and stuff like that. What I want to go to my kids, the individual things. It's just like itemization
Mm.
and taking the time to do it. That's why they pay an attorney to do it because nobody wants to sit there and But
Mm.
if you have the time, I took the time,
Okay.
you know.
And that's one thing is that we all take time out for things that are important for us.
Hmm.
And sometimes we don't take time out for the things that are important for us. And these are one of the things that I think everybody should at least take, especially around the springtime, to reevaluate your life as new beginnings, new things. Like, take this moment to go ahead on and start thinking about the happy times while things are happy, not when you're ready to leave any type of financial situation and become stressful.
Well, yeah, and it's like I tell anyone, I believe in having a team. If you're a business person, or To me, if you're making money, you getting up every day and you earning your hard-earned money, you deserve to have a financial advisor. I don't care if you have 5 million, 500, $5. Have someone to sit there to help you be able to put that in perspective so you can grow your estate, grow your legacy, grow your finances. It's not about what you spend, it's not about what you make, it's what you keep. And my mantra is, if you don't know where your money's going, you don't know where you're going. And I always think that, we as a community always talk about buy Black. What burns me up sometimes is you have a lot of Black designers. They want you to purchase from them, but to me, they never wear their own stuff. You see them European out.
Mm-hmm.
So if that's the case, I can go buy European myself. I don't need to give you my money for you to go buy European.
Exactly.
Right?
Yep.
So, I can go buy it myself instead of giving it to you to go buy it. And you telling me you're a designer and all that. That means, to me, we as a people need to continue to promote our own brands.
Mm-hmm.
Not promote our own brands for everybody else, for them to buy, and then we go buy elsewhere. That's not keeping the money in the community. But that's a sidebar. So.
Because I was about to say we on another topic.
Talking about life insurance.
Right. So now that we got all our stuff up and ready, how do we live without life insurance?
Oh, wow. Depending on which type of policy that you get, you can get what we talk about is the cash value whole life. And depending on what type of company you go with, if you go with a stock companies don't pay dividends, whereas mutual companies do. That's the difference when you're buying a whole life policy. So if you're buying a policy from, I'm not going to name any different companies, but companies who have mutual in them, they pay dividends. The dividends go to the insureds versus when you're dealing with a stock company, the dividends go to their stockholders. So that's why if you're buying a whole life from a mutual company, your cash value is probably going to grow a little bit better because you're getting the interest plus the dividends, which depending on the mutual company that you go with, you can get 6.2% on your money from a whole life policy. And the crazy part of it is 4%, 4.4% to 4.5% is guaranteed. So that's the difference.
Wow. Okay. So
you can use that money to pour into. It's a great tax shelter. It's liquidity. It's not like a 401k or anything like that where you got to wait to 59 and a half to use it. You can use it to fund your business. You can use it for retirement as a buffer between your 401k. So you've been paying into your 401k and it decides to get low, but you've been funding your whole life policy as well. You can stop taking money from the 401k and begin to take income from the whole life policy. If that cash value gets low, stop that. And then by then your 401k is built back up and you can begin to get income. So it's like a buffer between the 401k income.
So, because a lot of people have been asking me about this whole life policy thing, how much do you need to put in before you can start taking any other money out?
Well, it depends on one, policy design, how the policy's put together, and again, what type of whole life you get. So it's key that you sit down with someone who is really an expert when it comes to, because those policies are pretty much called infinite banking policies, high cash value policies, high equity. So it's just different ways to do it, but it's all about actually sitting with your financial person and them doing, the illustration to show you how the policy grows.
Okay. So
I can't give like an infinite number about how much you need to put in it. It's all about your end game, what you want this policy to do for you. If you say, LaShundra, I want this policy to equal, XYZ in 15 years, then we're going to sit down and we're going to negotiate. We're going to talk about numbers, and we're going to say, well, you know what, Anthony, I need you to put XYZ into this policy to get to XYZ in 15 years.
Okay. And the money that you borrow from that policy, say you only put in about 3,000, right? Just to start the money, just to start the policy off.
Mm-hmm.
And, say that all of a sudden I want a car, but the policy max out at about like $500,000, say 500,000. And I put in 3,000. Am I able to borrow against only the 3,000 I put in, or against the whole policy? And like I can say, like, I just want 200,000 out right now. I just need to get this.
No, what happens is whatever you're putting into a policy in the beginning, depending on the carrier, you may be able to get up to 80%. Sometimes it depends on the carrier, 80 to 90% of what you put in. So like you say, you started the policy with 3,000, 80 to 90% of that 3,000 you can take immediately, depending on the carrier.
Got it.
So like after 5 years, of course, the compound interest and the guarantees, it depends on what the number is, you'll be able to use immediately. And the good thing about these type of policies, they grow. Even if you took the money out, it's still growing as if you put that money, that money's still there. So that's the best part. So if, like you say, you put in the 3,000 and you took 2,800, it's still going to grow like the 3,000 was in there, period.
Okay. And then I'm pretty much paying myself back at a lower interest rate. Usually the interest rates are really low.
You're becoming your own bank. Exactly. Because there's a loan rate attached to most whole life policies. So depending on the type of insurance carrier, I've seen loan rates as high as 8%, some as low as 5%. And sometimes you can't even get that at a bank.
Right. Because I'm actually thinking now, like for people who are looking to purchase homes, if they have a whole life policy and they are living, and they've been contributing to it over this long period of time. And loans aren't considered income.
Exactly.
So you can actually take a loan out, get whatever you need, pretty much pay yourself back. And then, then another question then. So say if I take that initial 3,000, I borrow 2,000, which is about 60% of my original investment to myself. So I take out the 2,000, but the 3,000 still looks like as if I never took it out. And then I wound up paying back the 2,000, right? Does that 2,000 now, it looks like my total go up to like 5,000 now?
Well, it'll probably go up anyway, because the interest on the 3,000 has already went back up anyway. Because remember, your policy doesn't stop growing.
Right.
As if you took the money out. You're just paying back the loan portion.
Okay. And the portion is separate from the actual insurance.
Yeah.
Okay. So I'm following now.
Yeah. So like your death benefit is your death benefit. Like you said, $500,000 death benefit. You're not borrowing from the death benefit. The only time the death benefit comes into play is when, say, for instance, you took that 3,000 out and you passed away. They would deduct whatever loan you had taken out from that death benefit. That's how that part goes.
No, even better. Because you're only with debt anyway, so
and it's your money. You're using it while you're here, right?
So in other words, it's like okay. So then it brings up to another question: is say if I did a 500,000. I know I'm doing situational stuff here, but these are scenarios that I'm thinking of. Like, say if there is a $500,000 policy, and my actual cash value into that policy gets to $500,000.
It'll never happen.
It will never happen. Okay.
Most often, most policies like that, because the death benefit increases as well. So like if you started off with that $500,000,
Yeah.
and if you put $500,000 in there, that death benefit probably went to like 2 million.
Oh,
2 or 3 million.
It fluctuates.
So it's all increasing. Yeah.
That is so cool.
It's all increasing. It's like I said, it depends on the death benefit and the design of the policy. You can design it where the death benefit stays level, but most often we design it where the death benefit is increasing while you're putting money into the policy.
Okay, so why does the infinite banking or whole life insurance is always getting bad rap?
Because a lot of I think it's about the educational piece, and you have people who are uninformed a lot, and they don't understand. It depends on your community where you come from. You hear the thing, buy term and invest the rest. Who's investing?
Right.
When you invest, and in our community, one of the safest things to do or to try to do is what? Real estate.
Yeah. And ain't too many people owning real estate right now.
So it's like safe, the way inflation is and stuff like that, just like we just saw the banks getting hit. Guess what didn't fold? Didn't no insurance companies fold. Didn't nobody's cash value go down. I didn't see none of that.
You're right.
It's rare for that. The average mutual company has been around over 100 years plus. And in the past 75 years, not one of them has missed paying a dividend. 75 years of not paying a dividend. They've been paying dividends over 75 years. That's a long time.
That is a long time.
That's stability.
Yeah. And most companies, I notice, like, because it's the same thing with the stock market. Like, no matter how low the stock is or how high the stock is, usually it'll be a percentage rate of the value of the stock anyway. So I like this.
Yeah. And then also if you want to be a little bit of a risk taker, we have the IUL, the Index Universal Life. You can use that. You can even get higher returns sometimes if you want to be a little riskier. The whole life is for somebody that's looking for straight guarantees. They're like, nope, I don't have time. I want my money. I'm not playing. But if you feel like, hey, you know what? A IUL, that's another way to go. And the good thing about when you're getting an IUL from an insurance company, most of the time they have a floor, which means even if the market dips, you don't take a loss. The insurance company assumes all the risk.
Oh, wow.
But if it gains, guess who getting money? You.
I like this.
So you have, and those are two permanent things you can do aside from getting a term. You have term, you have whole life, and you have universal life policies.
Okay. You got me sold. Like, because I was actually on the shopping for life insurances outside of my work company. And the reason why I was looking outside of work was just in case for any reason that I do switch jobs or so forth, I feel like I don't have to start over.
Control it. Yeah. And one thing I'm going to tell you like this, Anthony, a lot of my clients who are business owners, depending on what they're doing, we have that conversation. I want to know what's important to you. If being a business owner, is it protection for if you pass away, or are you looking for cash accumulation, that extra bucket of money for retirement?
You thought like right now? I mean, for me,
yeah. So what would you be thinking about? The extra bucket of retirement, right?
Yeah. The extra bucket for retirement.
Okay. So I talk to them and I let them know, like, one of the benefits of having a universal life, an IUL, any type of UL, the premiums are flexible. So we do an IUL for $1,000 a month. Say you're paying into your IUL 5-6 years, business gets a little shaky. You're going to call the company and be like, you know what? I know my premium is $1,000. Can we lower it to $500? They're going to do it. That's one of the best things about an IUL, a universal life. Premiums are flexible. And you have a no lapse guarantee, which they really don't lapse out. Whereas with a term, you miss a payment, you done.
Wow.
You got to start all over. 2-year contestability, you got to start all over.
But again, like they say, it's cheaper.
Oh, yeah, you get more bang for your buck. But see, an IUL is like a term and whole life get married.
Right.
With an IUL, you can still get that death benefit that you're looking for, that high death benefit, but the premium doesn't have to be as high unless you're trying to do an IBC policy.
All right,
there are no cheap premiums for that because you're putting it in to use it as a bank. You're not going to do that with $50. That's not going to happen. $50 a month is not going to happen for you.
Okay, so yeah, and I know you did this as an example, $4,000, and obviously everybody that's listening to this, to make sure that you have that conversation to see what numbers and what works best for your wallet.
Yep. It's all about what you can afford. And what I also tell people is when you get a life insurance policy, guess what? You can buy another one. A life insurance is a closed contract. Can't go back and change it. The only thing that happens is if you get a policy and it has riders, if those riders have specific stipulations like ages and stuff, they may fall off as the policy grows. But the policy's done. It's the contract is done. But you have to start another one. So like me personally, I have 5. So you get your first policy, say you buy some more properties. Mm-hmm. That means you need more insurance because, hey, something happened to you. You don't want your family to lose everything you worked hard to get.
True.
So you can have as many life insurance policies on yourself as you want.
All right. I like this. I'm going to have to dabble into this some more. Because now you got me fully, intrigued on the different strategies of finances that we can do. Because ultimately, you can have one loan from one of your policies that comes with the other ones.
And see, a lot of times they give us a bad rap being in insurance, but people, to me, like I said again, it's about the education, and it's not shown properly. It's not shared properly. And people think a lot of us that are in insurance that we're just looking for a commission. When it comes to policies that truly help you, help our clients, the commissions aren't high on those policies. They're not.
Right.
So you find somebody that's just trying to sell you life insurance. Now those are the ones that's just looking for a commission. But if they're trying to show you a policy that can really help you while you're here, it's a little different. I mean, they really go on the extra mile to help you with your money.
I like that. Then yeah, we're gonna have to work some things out.
Yeah, you got to come on our show, How to Live with Life Insurance podcast.
Yay, let's go. So now that we're going to slide on over to the third segment, which is the features of the show. And what really the features for you. So like, what are you doing and what skills or habits that you feel that will take you to the next level?
Well, I do a lot of public speaking. I speak at events. I am an author. I released my book, which is called Girl, Boss Up and Lead.
Hey.
It was released last year. It is a book collaboration of me and other women business owners sharing our challenges and how we overcame them, and just to encourage others to not give up on their entrepreneurial journey. It's tough being a mom, and just being in a relationship and trying to run a business as well. It's tough. So we're giving our, all of our guts, all of our winning strategies of how to keep you intact. Don't let go while you're building your business. I do that. And then again, like I said, the financial mommies, we out here strong. I'm out here educating. I'm out here promoting. having life insurance, what it can do for you while you're here. We have the How to Live with Life Insurance podcast, where myself, the Fly Insurance Guy, Damone Smith, and the Walking Asset, Ladarius Hunt. We're us three together. We talk about how life insurance benefits you while you're alive. It's not always if you pass away, what if you don't? Let us show you how to use that to increase, financial stability, your financial foundation for your family, how to use that tool. Life insurance is a tool for you while you're living. Now, don't forget that it's tough because some people just want to get small amounts in insurance for burial and stuff like that. Nothing wrong with that. It's for what you need it for. But also, we want people to understand life insurance is free money. All you're doing, you paying a small amount for free money, because that's really what you're doing. You get $1 million policy, you're never paying $1 million in premiums.
Right.
You're never doing it. So why not make your babies, your family millionaires?
Yeah. Or even make yourself a millionaire from that policy. Everything you put.
And there's a way for you to make yourself a millionaire as well from those policies. You can start your kid with one. To me, a whole life kind of defeats the whole, depending on where you come from, though, it defeats the whole 529 program, because at least with financial aid, you don't have to disclose the cash value in a whole life or IUL on that for your kid.
That is true for most life insurance policies. They just say, what's the policy? They don't even ask for your life insurance.
They don't know how much money in them policies.
They don't even ask for them. They usually just ask, do you have life insurance? If anything.
It can be used, life insurance can be used as collateral for business purposes. There's so many different things you can use it for. So
yeah, we might have to have you back on and talk about the uses of your life insurance. Besides what we were just talking about, how to use it while you're alive, but now that you know how to use it, or that it's doable, to take that to the next level.
Mm-hmm.
Or just listen to your podcast, you know what I'm saying? So
over there. That's right.
Nice. Is there anything you want to say before we go to the final 4 questions?
Well, you know what? I'll tell anyone if they want to get in contact with me. My firm is in the Chicagoland area. You can follow us on Instagram, Financial Mommies. You can follow us. The name of my firm is Harmon Wealth Solutions. You can follow us there. You can follow me on Facebook, LaShundra Harmon. So you can do all of those different things if you want to get in contact with me. I am on a radio show. I'm on the Warren Ballantyne Show, Coast to Coast, the 10 Minutes with the Financial Mommies segment, where I talk about life insurance, underwriting, and all of those different things. I'm just ready to educate and continue to educate and show people what insurance companies can do for you.
All right. So where else could people actually purchase your book?
They can go to www.financialmommies.com. You can go there. You can send me your information if you want life insurance quotes or quotes about any insurance. You can go there to purchase my book, order a copy of Girl Boss Up and Lead. It'll be a signed copy. And then also you can go there and get my Money Moves Planner. It's just a simple one sheet that explains to you different ways. You can list your intentions. You can download several copies. You can make copies or whatever to show you how to get more acquainted with your money and where it goes. Because again, if you don't know where your money's going, you don't know where you're going.
All right. So can you explain a little bit, what is an insurance score?
Well, what people don't understand is insurance companies have their own scoring as well. So you have the Allstate, State Farms, when you go in to get auto coverage and homeowners, they look at your credit. So if you got bad credit, you are high risk. That means your premium not going to be low. So even with a life insurance company, it's the same thing. Most often people who are bad with money and stuff like that, they're deemed as high risk, which means they may, if you come across a company that'll do certain amounts of coverage up to $1 million or $2 million, no medical. If your credit is bad, they will still order a medical. on you. So you still need to be aware of that. Even though it says no medical, if your credit bad, they may still order medical because that's just they want to do their due diligence. Because if you have bad credit, they want to make sure you extra healthy because they're taking a risk by insuring you. So it's key. Insurance companies have scores. They rate your credit. Many of them. Not all, but many of them do. The A-rated companies do look at your credit before they insure your auto, home, or you.
That is crazy. Okay, so I'm going to make sure that all of my listeners know if they come to you with bad credit or if you're just looking to get your credit score up, please go to aboutthatwallet.com so we can set up this consultation to get your credit score up before you start looking into these policies.
Yes, credit is key.
Yeah. That's great. So great.
See, I'm educating y'all.
Great. Greatly appreciate it. Alrighty. So you ready for the final 4 questions?
Let's do it.
All right. So, number 1, what does wealth mean to you?
I like the term wealth. To me, it means time freedom. It means peace when you have wealth, because when you have wealth, you're able to sit back and enjoy your family because you've created something to bring peace to your family financially. So that's what wealth means to me. It means peace.
Yeah, we need that right now. So
thank you. That's why we work hard, right? To get the wealth, to get the peace.
Get the peace. Number 2, what was your worst money mistake?
Oh my goodness. I'm going to tell you, when I went to open my first salon, I was 21 years old and I'm so excited, didn't know anything. I rented a space that had no hot water heater.
No. Okay, keep going.
And they didn't care. $2,500 a month for the rent. And I'm like, you guys knew I was trying to rent this to create a salon. They didn't care. They wanted their $2,500 a month. That meant I needed to put the hot water in. They rented me the space without the hot water heater on purpose. Took advantage of me. That was the worst money mistake at 21.
So you had to go, did you buy the hot water?
No. I had to get out of the lease because I'm 21. Like, I don't know any. No.
Okay. That was my question. All right. Number 3. What is your favorite financial or non-financial book?
Oh, wow. I love so many. Right now I'm reading 12 Months to a Million. It's what I think by Brian Moran. I love this book right now. And Think and Grow Rich, of course. But The Psychology of Money.
The Psychology of Money. I haven't heard of that one.
Look it up. Very good book. Psychology of Money. You just learn so many different things. That's one of the things. It's just like, oh my God.
All right. Thank you. For that. Thank you for the book recommendation. I like those. And the very last question is, what is your favorite dish to make?
My favorite dish. I love to make pasta. So I like I love peanut pasta with vodka sauce.
So good.
I know, right? I like that. And I love spaghetti too. So I like to make spaghetti. Oh, and I like to make tacos.
What you put on your taco?
Oh my God. I'm not traditional. I love turkey with the turkey meat, ground beef. I'll eat either one of those. And I just like the shredded cheese and lettuce and the taco sauce.
Okay, nice and simple.
And I like corn shells. Soft shell corn shells.
Okay. I'm about to say not the crunchy joint. Like,
No.
can't do the crunchy. Like the whole roof of your mouth been gone. Like
No, soft shell corn.
Okay. Awesome. All right. So obviously the last question, you answered it a little bit earlier, but just remind the people, where could they find out more about you?
Oh yeah, I'm all over Instagram, Twitter. You can follow me at Financial Mommy. My moniker is at Puck Billions because my nickname is Pucky and everybody know I'm about money. So they call me Puck Billions. So they can follow me there. But I'm on Facebook as well. So you can follow me there. Facebook, Instagram, and Twitter at Financial Mommy, at Puck Billions, and LaShundra Harmon. You can look me up, and hey, if you need help or have any questions about life insurance or any insurance, I love commercial a lot. So I do a lot of commercial insurance and business insurance. So I should call myself an expertise at that type of stuff too. So I love it all. Anything insurance, you can call me.
And just let them know where you heard it from the finest podcast around at the About That Water podcast show. So.
Weaver is the man. It's my brother. Hey. I'm grateful for you, Anthony. Thank you.
Oh, thank you so much for coming on the show. It's been a pleasure. And everybody that's listening right now, I hope that you at least got one thing out of this. And if anything that you did not get out of it, hopefully you got the one thing, which is take action and take action of your life and also your finances. This is what this show is about, to help you build strong financial habits. So let's go out there and take action. All right, everybody. Y'all be safe. I'm out. Peace. Welcome, everybody, back to another exciting show of the About That Water podcast. I am your host, Anthony Weaver, and I have the lovely opportunity to bring on LaShundra. Oh, my gosh. I'm so sorry for your last name.
LaShundra Harmon. So start it over.
Yeah.
LaShundra Harmon. A financial mommy.
Okay. Thanks.
We friends.
No. All right. I'm going to do the pause so I can know when to cut. Welcome, everybody, back to another exciting show of the About That Water podcast, where we help you bring strong financial... I can't even do my own thing. That has been a while. Sorry. Okay, ready.
We flowing here. We good.
Here we go. Okay.